Now first rates will just start coming in. It's Wednesday morning. We are not expecting anything large, or we're not expecting anything big from any of the individual stocks here. So I'm just going to restrict it to the Sensex and the Nifty. And it's a very flat start, both for the Nifty and for the small cap index. Small cap index on a relative basis is doing much better. Let's address the newsmakers here. ICICI Pru, roll it back to what is happening to Bajaj Finance, and then ahead of numbers Bajaj Auto, Wipro, and also what essentially is a trend. That's Bajaj Auto for you. Nothing big or nothing powerful. Wipro is not doing anything special, and frankly Bajaj Finance also, it's turning out to be more like a no-go despite encouraging setup from this. Aisha?
Yeah, just a couple of other names which are going to be in focus as well this morning. And while that's Bajaj Finance, let's revisit what HDFC Bank is up to. While it did not really tank yesterday, you didn't see any material follow through come in on that stock, and today it's actually squared off all of yesterday's gains. It's again down about 0.6%. So just a one-day respite really is what you saw on HDFC Bank. I can see a sharp gap down on Hindalco after the OFS got announced just last evening. So that's another stock which is in focus as well this morning. Remember, the government is looking to sell about 7% stake via OFS. The offer price has been set at 79 rupees per share. This Canfin Homes, strong set of numbers. The second quarter NIMs have come in at a six quarter high of about almost 3.8%, which is clearly above estimates. Yesterday also the stock was a big mover. Tata Elxsi also should be reacting to its numbers. The profits have risen really nearly about 6% on a sequential basis. And then of course, there's Mazagon Dock as well, which has bagged a defense contract of 310 crore rupees for training ship supply. That stock gaps up 3% higher for Mazagon as we speak right now. There's IRCTC Zomato as well. They've signed an agreement for supply and delivery of pre-ordered meals. IRCTC marginally higher. Zomato is now at 114 rupees per share. There's, Nikunj flagged off ICICI Pru, Bajaj Finance. There's L&T Technologies as well. The results are healthy, but the constant currency revenue growth guidance has been cut, so look out for that. And then, of course, there's Syngene, where the numbers are disappointing. That stock should be down. There's Biocon, wherein the US FDA has clarified insulin manufacturing unit at their Malaysia plant as OAI. That stock as well gapping down 3% lower as we speak right now. So these are a couple of stocks which are in focus. There's also earnings from a Zensar Tech, from a TCI Express. We're going to be chatting with the management of TCI Express as well. A margin squeeze coming in on the numbers there this quarter. There's Happiest Minds as well, which also is in focus this morning. That stock will just come up for you on your screens as well. For the index though, we're pretty much in line with what's happening across the rest of the globe, which is really nothing. Some quiet consolidation with a tad bit of a negative bias. Kunal, what's your take? Another day of consolidation?
Yeah, it seems like another day of consolidation. The Nifty futures has actually gone to discount 5.7 points so far, but still it's a discount compared to the long expiry which we already had so far for the October series. In terms of the opening trade, I'll stick to the stock which I suggested yesterday, that's ACC. That's a stock which I believe is heading towards a breakout both on the short term as well as on the medium term charts.
All right, Naresh, let's get in your take as well on the market open this morning as we're sub the 19,800 mark. What's your take and first trade that you're punching in?
So the index continues to be sluggish, but the small cap index is at a new 52-week high and an all-time high. So clearly the broader markets continue to be in favor. So nothing much to take off it unless and until we see some heavyweights taking leadership. On the stock specific side, oil and gas looks interesting, and that is where IGL looks promising. So at 485, 488, this is a stock which I will go for.
Manish Kanwani joins us now. It's been a while I haven't interacted with him. So let's connect with him to understand what he makes of the current market setup. He bought a lot into hotels and hospital stocks in his previous avatar. Is he doing the same or has he identified some new trends? Let's discuss all that and much more with him. Manish bhai, so good to have you back. Thank you for joining us.
Hi, Nikun. Thanks for having me.
So where do we start with? Your great call on Tata Group, hotel stocks and hospital stocks, or we should simply talk about the big picture first?
No, so I think the new themes we are more positive on, which are basically things related to power capex or revival in rural consumption, pharma. So these are the new set. The ones you said are a bit old right now.
39. Okay. So let's understand where we stand. And I'll just put this sheet out. And this is a pure, very basic sheet. You look at much more sophisticated data here. But this is the P multiple of the small cap index and the large cap index. When I say large cap index, Nifty. The premium between the small cap index and the mid cap and the small cap index and the Nifty is almost equal now. And small cap indices now are trading above their 5-year average. So do you think now, forget amber light, it is red light for small and mid cap stocks now?
No, Nikunj. Actually, I do think that while obviously small caps tend to be volatile, on a 2-3 year basis, that is where the big return will be made. The big picture, as you said, I have is that we are living in times where I don't think you can be very bullish on global economic growth because China seems to be structurally slowing down, US likely to go into a cyclical slowdown over the next 1 year or so. Japan, China, Europe, we all know that they seem to have big demographic and debt issues. So if we are living in a time where global growth is low, but I think liquidity will be good because frankly, I think the debt levels in the world are such that you will not see very high real interest rates in most economies. And my hunch is that a lot of the Western central banks will also become dovish a bit earlier than people expect. In which case, if you combine slow global growth with good liquidity, with the fact that India seems to be having a superb relative position within emerging markets, then what will happen, I think, is a lot of the mega caps will struggle to grow because they need global growth and domestic growth to fire the industry growth because the mega caps, by definition, cannot outperform the industry by too much. And I think a lot of the smaller companies will, if they have a good business model, good management team, if they are on the right side of tech disruption, or if they're part of a global theme, I think. So I'm not necessarily saying that the entire small cap index will do well, but I'm just saying that unless we have some exposure to small caps, I think it will be difficult to generate high returns.
Why are banks not participating? That's one sector where you can see like you have a 6x6 visibility for next 3-4 quarters and the markets are just not rewarding them.
Yeah, Nikunj, we're also sometimes breaking our head on this. But I think the logic is actually that if you believe in reversion to mean, first of all, the ROA of this industry today is at its peak, all-time peak, right? So if you believe in reversion to mean, the first thing is something may go wrong. And the second part is if that's something which is going wrong, where is it likely to be? I think it needs to be in retail lending, right? Because most of the big banks have moved away from corporate lending. The entire growth has come from retail and to a certain extent SME lending. Now, if you believe that the next down cycle in credit quality is going to happen in retail credit, that is the only perspective from which you should be concerned about bank, because I guess growth and valuations are fine at this point of time. But I think the subconscious thought maybe apart from the ownership angle, that obviously these are very well-known names. The fear I think at the back of every investor's mind is this is too good to be true, and when the next cycle comes, unfortunately, I think there will be no hiding place. So if you see the previous cycle, when the corporate loans went bad, we had a set of banks to hide in, which were predominantly retail banks. But I don't think that if there's a broad-based downturn in retail asset quality, apart from some very niche NBFCs, maybe, I don't think there will be any place to hide in this sector. So I think that's somewhere playing on everyone's mind.
Sure. Manish, what's happening within the big boys of the private banking world? I mean, we've all seen stark underperformance from an HDFC Bank, which I think has lasted over 30 months now. We were just looking at Kotak valuations, which are now lower than ICICI Bank. I mean, in the past, Kotak has always been at a premium to ICICI Bank. That's clearly not the case. ICICI Bank seems to be the only go-to, and rest all of them have been underperforming. Why is that?
So two things here. First of all, as I said, if your fear is retail credit going bad at some point, then there'll be a kind of homogeneous pain across the sector, in which case the logic would be, why would you be in a high price to book bank? The other thing is, obviously, a lot of investors were underinvested in PSU banks or NBFCs, which were like below price to book because of a lot of exposure to infra or corporates. And now at this point, actually, if you see the ROE of maybe the top 10 lending institutions, everyone's ROE is broadly the same. I mean, someone would be at 14, someone would be at 18, but there's not so much of differential in ROE. I know this is not sustainable. As I said, the ROA of the sector today is probably higher than 2010, which was the previous peak. But the simple point is the valuation gap between the companies which are around 1-time book and 2.5-time book, at least optically sometimes is difficult to justify because the ROE convergence has happened. Now, if the ROE diverges again in future, obviously you could say that the large private banks will start outperforming. But the trillion-dollar question is, when does the ROE divergence begin again? Because at this point, the feedback from the ground seems to be that retail credit quality is still holding up. So in that scenario, I think people are kind of flowing to the cheaper banks rather than the higher priced book banks.
Let's also get in a sense as to what the outlook is when it comes to the rural economy recovery going forward. Do you believe that we are likely to see a private capex pickup, that the festive season could bring cheer for companies that are closely linked to the rural economy, and that could be a big booster shot?
Yeah, so I think medium term, the rural economy should revive. Whether this festive season or not, I'm not sure. But I think the simple point is, if you see since the COVID, we have seen very weak rural consumption, and that is clearly because COVID and inflation, the twin shocks hit the balance sheet of the bottom 50%. And it takes time to recover. So the recovery process is on. Jobs are back, a lot of construction work is back, food prices are okay. But I think the balance sheet repair is taking some time. Second is that we have a fairly heavy election calendar ahead, and that helps. But having said that, doesn't mean that you need to be in very penetrated consumer goods stocks, which are at 50, 60p. So I would say two-wheelers and microfinance probably are better ways to play rural rather than FMCG.
Manish, if the starting point is today, which is 18th of October, next 3 years, what should be a projected return according to you, based on the starting point and the view on earnings?
So I think the large cap index should do somewhere low teens, and I think the small and mid cap index should do a bit higher than that, my base case.
Small cap can give better returns from large cap, even though starting point is today?
Okay. I'm just saying that if you have a universe of good 30, 40 small caps, that will do better. The small cap index is a bit dicey because it tends to have 150, 200, 300 stocks. But I do think, as I said, that unless you have some small cap exposure, it will be difficult to create a big return.
Could you give us a flavor of what exactly do you like in small cap? I mean, in terms of a theme, without getting into an individual stock idea here, can you give us a sense of where you think there is a nice, clear visibility based on the current framework?
Yeah, so a lot of the 3-4 themes we mentioned, but basically, I think, for example, if you see this whole power capex segment, it has a lot of legs. There, domestic, there is a demand supply gap. There is a big global cycle, which is basically the transition to renewables with upgradation of the grid in almost all countries. And there's a China plus one angle also there that if the Western countries have to do this transition, at the same time, they're not wanting to buy too much from China, which leaves India as a big potential supplier. So you have good tailwinds on that power capex value chain. Even in financials, I think will be a reversion to asset quality in the microfinance space. Also, the smaller banks, even if they are expensive, I would probably tend to prefer them over the big private banks because, as I said, I'm not very positive on global growth or even India growth going back to 8-9%. So if you're not very positive at a macro level, you're better off buying a bank which is 0.2% of the system can become 1% of the system, rather than buying a bank which is 10% of the system, because I don't think it can obviously become 30% of the system. So to that extent, because as I said, the macro growth is limited. In a lot of sectors, if you can get a good management team and a good business model, the lower base, I think, will help. The third is basically in pharma also, for example. I think there are select mid and small caps which have got beaten down over the last 3-4 years because either product issues or FD issues. So there is a host of mid and small cap pharma names which make good risk reward as well. So I think there are a lot of these segments where, given the low base of the small caps and the fact that some of them may be on the right side of disruption, right? So there are good optionalities in some of these small caps which are in EV, which are in OTT, QSR also. So I think a lot of these high growth segments, unfortunately, are very small at this point from an economic angle, in which case you will need to be in small caps to play these high growth segments. Because honestly, I don't think there is growth in big segments right now, and I don't think it's likely next 2 years.
Let's also get in a take as to how you're looking at really playing out the entire manufacturing theme, and where exactly do you believe that there is opportunity within this space?
So as I said, chemicals is where the China plus one thing has played out. With the stocks right now, are going through a bit of a earning issue because globally demand is low. And because they've done well over the last 8-10 years, I think the stocks are expensive. So personally, I'm not very bullish on chemicals. But as I said, this entire power equipment value chain, which is transformers, substations, cables, windmill equipment, and all that, I think that can be a very scalable opportunity if we play the cards right, because it's very rare to see almost every country do capex in one segment at the same time. So because of climate change and geopolitical considerations, you are getting a phase of maybe 10 years where almost the entire globe is transitioning to renewables at the same time. Obviously, that can be a mega opportunity. So in that sense, I think we need to see, obviously these stocks have done well, so they're no longer cheap right now. But all these stocks on transformers, power wires, cables, etc., I think the opportunity space seems quite high. So they may go through a sustained re-rating as earnings keep flowing in.
Sure. Manish, great to have you on the show and getting all that insight on the markets and, of course, how investors should be approaching their portfolios.
Thanks a lot.
Okay, that's the take coming in on the markets, which, by the way, are still pretty quiet. It's a no-go, really. We are sub that 17,800 print on the Nifty, pressure on LTTS and ICICI Pru Life, Syngene, Biocon and Bajaj Finance, by the way, is now down 1.6%. It's one of the biggest drags on the index at the bottom of the heap right now as we speak, along with Bajaj Finserv too. But MCX and brokers are now reporting problems with the new MCX platform. What are these issues that they're facing? Sharad is here with all the details. Sharad?
Well, yes, MCX is in focus and the implementation has already started of the software itself, but the initial feedback which is coming as per our channel checks, it suggested that there are some glitches happening across the order placing. Now, there is some delay as well as some issues are coming, especially on the contracts front, on the crude front, especially on the high and the low prices. And of course, we did chat with the other dealers as well as traders, and they have stated the volumes overall, they have been down, and channel checks suggest roughly 40 to 50% downtick in volumes have been there. If you compare this first 2 to 3 days of entire implementation as compared with the last 2 weeks going ahead, and also there has not been a proper redressal mechanism being set by MCX currently. So overall, there has been no intimation also coming from the company itself. So it's a very developing story, and when the redressal happens or if the software implementation goes smoothly, we will inform you.
That's the take coming in on MCX. Early days yet, and it seems like there are some tech troubles as well coming in there with the new platform. But let's shift focus and let's try and understand what's happening with the chemical sector. You know, there's been a lot of resilient domestic demand that one has observed. There's dumping by China, which is now seems to be abating. There is, of course, the rise in crude prices, which also is a niggling factor, and the stimulus in Chinese economy. So a lot of headwinds and tailwinds combined. Let's try and understand what investors should be doing and how they should be reading the macro when it comes to chemicals. And who better than Ajay Joshi, who's an industry expert, to join in and explain to us exactly that. Ajay, hi, morning. Good to have you on the show. Ajay, there's been a surge in prices for certain chemicals, right? Like soda ash, caustic soda, etc. What's the main reason for that? And you think this uptick is sustainable to begin with?
Good morning and good to be back. I think the surge was very, very spot. It had to do a lot with the Golden Week slowdown in China. Entire China chemical industry was shut. Traders were off the market for last 2 weeks. So if you will see the price trend of soda ash, caustic soda, phenol, acetone, all the commodities basically, last week of September and first week of October, we saw some surge. But then the second week of October, the prices started stabilizing. And today I have just gotten the fresh prices from China for caustic soda, soda ash. Again, the prices have started declining. In fact, the soda ash and caustic soda prices are down 3% and 4% respectively compared to last week. So the price trend surge was very, very spot. It had to do with lesser supplies in the market against steady demand. But now the Chinese companies are back in the market. So the price surge would no longer be there, and prices have again started declining for these commodities.
All right. Ajay, I wanted to also get in a sense, because the last time you came on the show, you had highlighted that the China dumping will continue till Q2, as well as with improvement expected by the end of Q3. Is there any signs of abatement of China dumping?
Yes. On China now, the domestic demand is slowly picking up. So a lot of inventory dilution in China is happening. So in case of specialty chemicals or multi-stage derivative chemicals, which are more on the specialty side, there we are seeing some price increase from Chinese suppliers. So this will give very good opportunities to Indian companies who are in that derivatives space. So in that way, China dumping is reducing, but in the agrochemicals space, it is very much there. So for agrochemical companies in India, they will continue to face the brunt of this Chinese dumping in the export market, particularly Latin American market and Southeast Asian market. But for specialty chemicals, now we are seeing that the dumping is going to be less and less effective from China.
Right. The other thing, Ajay, also that I wanted to understand is that we're seeing good export revenue growth for certain contracts, and especially specialty chemical companies. I mean, case in point being Navin Fluorine. Does it mean that finally global demand as well is on the recovery side?
Not yet on the recovery side, to be very, very honest, because in the coming quarter, the US demand will be very, very sluggish. Latin American demand will pick up, Southeast Asian demand will pick up. So we will see some contract manufacturing orders move in faster than the last quarter, like for PI Industries and Navin Fluorine. But there will not be any drastic change in terms of revenue growth with regard to contract manufacturing business. But not Naveen. My focus company is PI Industries. With PI Industries, they have a very, very healthy order book. And now they have also gotten into this API, pharma API space also with the acquisition of a couple of companies. So rather than Naveen, I would focus on a company like PI Industries, which is a true blue contract manufacturing companies. They have contracts of patented molecule with 20 plus global innovators. So a company like PI would outperform a company like Naveen in the coming quarter.
All right. What's the outlook in terms of Q2 performance? How are you seeing it? Is there any anticipation that we could see guidance cuts from companies?
From global companies, yes. Global European companies in particularly, there will be some guidance cuts like BASF, Croda, Covestro and all these companies because the demand still is very, very meek. The prices are not what they used to be last year. And previous year also. So from global companies, we will continue to see some pushback. Even the investment decisions by a lot of these global companies have been halted. They were to invest into new capacities in China, in Europe, as well as in America, but they are also not taking any call and all the decisions have been pushed back by 2 quarters or more, even by the global companies.
Sure. When I talk about valuations, UPL is looking attractive, right, as compared to the other Indian, even as, versus the global peers. Analysts are also very bullish on the stock. What is your own take?
I think my problem is that, most of the time we get sentimental about these chemical companies in Indian chemical industry, but sentiments, they don't care about facts. For UPL, the coming quarter is also going to be challenging because the US demand, like I said, will be very, very slow in terms of agrochemicals molecules. So although from Latin America, due to good El Nino season, demand will pick up for UPL, but the US demand will be very, very sluggish. So I don't know how much they would be able to compensate from the uptake in the Latin American demand for the US demand sluggishness. But I don't see, to be very honest, I don't see any good reason to be that bullish about UPL right now. Next quarter, definitely yes, things will turn around for UPL, but not in this quarter, not in short to medium term.
All right. So what about the outlook then? Just paint a picture as to what the long term could look like for the next 6 months or so in terms of demand, in terms of pricing. How are you looking at the entire chemical space?
In the next 6 months and after that, we will see price stabilization. Right now, prices are still very, very volatile. 1 week, we are seeing price surging. Another week, we are seeing prices coming down. But within next 6 months, the prices will stabilize. So we will have better visibility in terms of pricing. Second thing is that the demand will pick up for agrochemical companies, for agrochemical formulation companies. So companies like Bharat Rasayan, companies like UPL, companies like Insecticides India, they will see, very, very good demand coming in after 6 months. Specialty chemical company, the recovery will start from the January of next year immediately. They will see much better pricing. They will see much better demand. For contract manufacturing companies, the recovery period has already started. I think I had said this in August also. So with the demand for PI product, demand for Naveen product, we are already seeing that. PI is also working on launching 3 new molecules for the patented companies. So that will again result in some incremental revenue for them. So for contract manufacturing companies, the recovery has already started and it will be onwards and upwards from here only. Agrochemical after 6 months only. For commodity chemicals, after 6 months only, prices will stabilize and we will see some stable demand. So overall, till next 6 months, situation will be dicey for all the sectors within chemicals space, except for contract manufacturing.
Thank you.
Thanks so much for taking time out and joining in and giving us more perspective on the entire chemical space. Time for a very quick break. Do come right back. We'll talk about the earnings in greater detail. Good to have you back with us. Still tuned into First Trades. A little bit of a scale back for the frontline index above the 19,800 mark. What's leading to that move? Well, by and large, you've got support coming in from the likes of the pharma, metals, as well as media sector to a certain extent, as well as gaining traction. Quiet as ever when it comes to the broader universe. And within that space, though, names like Aarti Drugs, Spark, Karur Vyasa, Tata Elxsi, as well as Godrej Industries, those are active in trade today. But time to put the spotlight on the entire auto and auto ancillary space. Are we really going to see the festive frenzy boost volumes across the board? What are the levers for growth? Let's connect with Aniket Matre, who is joining in from HDFC Securities. Good to have you on board. Let's get an overall sense from you as to what we're expecting in terms of the festive season push from the earnings sector, from the earnings as well this time around.
Hi, thank you for having me on the show. Good morning. So as far as the Q2 is concerned for the auto sector, clearly we are seeing passenger vehicles and commercial vehicles have delivered a pretty decent growth, about 8 to 7% growth. Two-wheelers and tractors continue to lag. Two-wheelers have seen about a 3% decline, and tractors have also declined year on year in this year, right? So which means those companies will face some earnings pressure. In terms of earnings surprises or earnings improvement over on a sequential basis, what we are expecting is players like Maruti Suzuki, for instance, will do very well in earnings this quarter for the simple reason that the UV mix for Maruti has improved substantially. UV mix in Q2 stands at 33% relative to 25% last quarter, which means that there will be a relatively much improvement in margins. We expect a 130 basis points margin improvement for Maruti this quarter, which should help earnings growth overall for Maruti. Coming back to two-wheelers, within two-wheelers, the best place seems to be TVS Motors, which has delivered almost a 12% kind of a growth this quarter, and of course has outperformed industry as always. TVS is expected to lead the pack with a 15% earnings growth in the two-wheeler space, according to us. Players like Hero MotoCorp and Eicher Motors, for instance, are likely to face some margin headwinds for the simple reason that we expect ad spend or promotional spends to normalize with the new launches this quarter, which should mean that those players will see some margin headwinds this quarter on a sequential basis. Coming to commercial vehicles, clearly Ashok Leyland and both Tata Motors in the CV space will deliver a pretty decent set of numbers in terms of sequential earnings improvement because they have seen a pretty decent sequential volume growth. That's largely the take on OEMs from us.
Aniket, do you think the bigger move or surprise would come in from tires within that? Because, yesterday we saw a great performance from CEAT, and the management, actually, we spoke with them yesterday, are pretty confident that even with the RM basket uptake, they will be able to hold on to their margin range. Do you think that's the space that one needs to be in?
Right. So CEAT has certainly surprised positively in terms of numbers, right? If you look at CEAT margins, they have improved 200 basis points clearly on a sequential basis because the raw material basket declined 2% sequentially while they were able to hold on to the prices. So clearly, I think tire space looks pretty decent at the moment, yes. But at the same time, one has to also see on a stock specific basis, right? Because a lot of tire stocks have also done well in the recent past. Names like a CEAT and even MRF has rallied quite a bit. So within the tire space, we still like Apollo Tires, which has sort of underperformed a bit related to peers, but the performance continues to be upbeat for Apollo. So within the tire space, I think Apollo remains our preferred pick at the moment.
Are also looking at building up the inventory in anticipation of festival season. That is what Maruti told us, and that is what we are getting a sense from other car companies. But there is a what if. What if sales are not strong? What if footfalls are not strong? What if consumer does not come back? Is that a risk from a market standpoint also to auto stocks, that what if happens?
Very rightly put, Nikunj. For instance, for passenger vehicles, right, you still have a pretty healthy order backlog. To that extent, even if stocks are there, I think they will get liquidated very soon. I think for players like Maruti, they have already liquidated their slower moving inventory, which is the cars category, or rather, I would say they have sort of lowered their inventory in the car segment. And for UVs, you would be aware there's a very healthy waiting period across the board, be it Maruti, M&M, even Toyota, Tata Motors, etc. So everybody is seeing a very upbeat kind of a demand momentum in utility vehicles. Coming to two-wheelers, for instance, yes, there is a clear risk that if demand does not pick up, there could be some inventory pile up, especially in the entry-level segment, which is still lagging behind, right? The rural segment has not recovered yet, and that would mean that if festive season is not what OEMs are expecting, we could see some inventory pile up for sure within the two-wheeler industry. So I think two-wheelers could be at risk relatively related to passenger vehicles.
In last 2 years, and specifically if I look at last 2 year data, Tata Motors has hit out of the park, TVS Motor has hit out of the park. Similarly, the old economy companies, when I say old economy, Maruti is old economy for me because they are not moving to EV. Hero Motor has done nothing. They've underperformed. Do you think now it's time to flip where this entire EV dominated auto stocks could take a backseat and the traditional ICE engine auto companies will make a comeback?
So specifically, if you were to ask me between Maruti and Hero, since you mentioned relatively slower on the EV run, I think Maruti is doing relatively much better than a Hero MotoCorp, for instance. Like if you were to look at UVs where Maruti was lagging, they are already have improved their market share in the second quarter to 28%, and for H1 their market share stands at 25% now, which is much higher. In FY23, you would recall they were as low as 12%. So they are ramping up their presence in the utility vehicle space, which has been outperforming recently. So Maruti seems to be doing very well related to peers, and EV transition in passenger vehicles has not yet picked up. So to that extent, Maruti has not been as impacted with EV transition relative to what two-wheelers have faced, right? Coming back to Hero MotoCorp, for instance, Hero MotoCorp, as you rightly pointed out, in terms of new launches, while they have seen a slew of new launches, but market share recovery hasn't happened yet for Hero MotoCorp, even as we speak, right? In Q2, they saw Extreme 160R getting launched. They saw the new Passion launch. They saw new Glamour launch, and they have just recently launched the Charisma as well, right? Despite the new launches, we have not seen any market share uptick for Hero MotoCorp, which continues to be a concern, and which is the reason we are have a reduced rating on Hero MotoCorp at the moment. So the pain in Hero MotoCorp is the fact that the entry-level segment is not doing well, and the segment that is doing well, Hero is underperforming that category.
Okay, Aniket, great to have you on the show. Thank you so much for taking the time out and joining in today. Let's just revisit what the market is up to. At an index level, we're really not doing anything. HDFC Bank, of course, has reversed the gains from yesterday. Bajaj Finance is your top loser on the index today, 1.6% lower. There's ICICI Bank, which is down about almost 0.5%. M&M is down today. HDFC Bank down 0.4%. Some of the crude sensitives with the crude spike all the way to now 91, they're also abating. So, an Asian Paints being such case in point. While the one sector which is really shining today, it's all through and through metals. So pick up a Hindalco that's holding up 2%. Nalco is up 2.25%. There's Jindal Steel, which is also higher by about 1.7% as we speak right now. But the result candidates and the disappointers there, LTTS, ICICI Pru, Biocon, Syngene, of course, there's news flow impacting these stocks like a Biocon. Syngene, of course, is reacting to its earnings. And then Bajaj Finance, which is down about 1.6%. Curious case though, Nikunj, because earlier we were chatting that, looking at the valuations, there's actually comfort on the table. The numbers are in line. So there's actually reason to add up positions at the current levels.
See, Asha, 1% for a stock post-reaction is something which you should not really look
Negligible,
at it.
yes, of
It
course.
was at 7,200, which has become 8,000 when financials have done nothing. So if you frankly look at Bajaj Finance this year, it will be a double-digit return when the Bank Nifty may have not given you great returns. So actually it is going against the grain, so to speak, because it's a large cap, institutional dominated stock. There you go, 21% for Bajaj Finance this year versus the Bank Nifty. It's fair to compare Bajaj Finance with the Bank Nifty because of the size of the balance sheet right now. But this year, while the Bank Nifty may have done nothing, that's what I remember. Let's actually wait out for the data, because the Nifty is at 7 or 8%, and the Bank Nifty return this year has been just flat to uneven kind of a return. Just pardon me, I think something wrong with the graphics, but I'm reasonably confident that Bajaj Finance has done rather well. There you go. So look at the outperformance. I mean, for a stock which had a great 2021, great 2022, has had another great 2023. From the COVID low, which was sub 2000, Bajaj Finance is actually 4x. And none of those stocks in the banking space have done even 3-4x or remarkably even close to that. So, 1% here or there does not matter. But what brokerages are talking about, price targets of 9,000, 8,800, 10% upside in 12 to 18 months, it's conceivable. I mean, it is not something where the stock will become like a P multiple of 10, 15 times. It is entirely conceivable to say that a 10-12% move in 12 to 18 months for Bajaj Finance could really be par for course in line with averages, purely because the starting point right now for Bajaj Finance, even with superior growth, is much lower than what it was commanding pre-IL&FS crisis and pre-COVID. But here's an excerpt of a conversation with Aman Chauhan of Abacus on where they are finding value in this market.
We have 2 or 3 metal names into our portfolio. So incrementally, we are further deploying cash into these names. EPC is looking good. Quasi real estate plays like, say, laminate companies, cement companies, MDF companies, tiles. So this is something where we are pretty positive on. So that is where bulk of the consumer money has gone in the last 2 months.
And where are you doing the reverse, which is where are you booking some profits? I remember you bought into companies like Tesmaco, you bought into Titagar or Tesmaco, I don't remember, but one of the railway companies, Titagar you bought into, you bought a lot into mid-tier banks, your investments in companies like Route Mobile. Have you locked some gains there?
No, as you said, the inflows are on, so there is no hurry to lock profit there unless valuations are got out of sync. So we have an internal rule that single stock doesn't exceed 10% of the portfolio. So wherever stock holding has gone 8 or 9%, there we have booked profits. So we are cautious on chemicals because we feel next 1-2 quarters there'll still be some margin pressure. So very selective on the chemicals front.
And we were discussing the entire, the argument whether the elephant will dance or not. And we're talking about the elephant HDFC Bank. That's doing all right now. But I'm looking at your top large cap picks from the banking space, and ICICI Bank features on the list. Preferring ICICI Bank over HDFC Bank, or are you looking at changing that view a bit?
For now, we're sticking to what we own. But having said that, HDFC Bank definitely is looking attractive. We are, for the first time, started to look at it. We never have owned it over the last 4-5 years now. But at 15p FY25 earnings, what the consensus earnings is, there's definitely value and there's definitely merit to look at HDFC Bank.
Now, the current quarter is not great for IT. But looking at the order book, what they've indicated, purely the deep deal pipeline, looks like FY25 will be a big comeback year for them. And maybe that is the reason why IT stocks have not fallen flat despite disappointing set of numbers. Is there a valid view in assuming that next 6 months tough for IT, but next 12 months or next 18 months could be great?
Yes, we have the same view. That's the reason we have not sold or reduced our IT exposure. We are holding on to what we have. So next 2-3 quarters are not going to be great, but the way people look at IT is sequential growth. So fine, when we're heading for the December quarter, which is a seasonally, because of holidays, a weak quarter, post which the sequential rates can pick up and then the stocks can continue to perform. So that's broadly what my view also is on IT.
Okay, Suresh Iyer joins us now, Managing Director and CEO with Canfin Homes. Suresh, good morning. Thank you for joining us. Now, disbursements have declined 10% year on year. Was this an exceptional?
Sorry?
The disbursements for the quarter gone by, they are down 10% year on year. For a market and for a category which is growing, why were disbursements down?
First thing is you would be aware we had a small this thing at Ambala which was there. So we had some tightening of the processes and we have centralized some of the activities. So there was a little bit of disturbance in the processes. But in terms of our the way the market and the inquiries and the loggings are happening, we are confident we'll be able to bounce back in the coming quarter. But this quarter we have tightened some of the processes and looked at some of the internal process things. That's the main reason why it has slightly been affected. But on a sequential matter, the second quarter has been a little better than what it was in the first quarter, and our inquiries and logins are a little healthy. So we are quite hopeful in this quarter it should be able to pick up further.
So for the full year, are you likely to report a flat growth because of this issue, or you could come back in Q3 and Q4?
Q3 and Q4, we are very hopeful we'll be able to do better. And we had a good first quarter also. It's only because of the second quarter where slightly it has gone down. But again, Q3 and Q4, we should be able to pick up. So by the end of the year, we'll definitely clock a good growth.
And is that 18% growth guidance for FY24? Are you sticking by with that number?
Well, yes, we are quite hopeful because the market has been very positive about it. This quarter, another small thing is that, prepayments have there has been a little uptick in the prepayments, which also we are addressing. So that will be one of the monitorables. Otherwise, in terms of the disbursement, we will be able to pick up. So it should help.
Just clarify a little bit more in terms of disbursement as to what exactly it is that you're expecting.
See, we had originally anticipated a disbursement around 10,500 crores. So this quarter being a little slightly lower, we'll try to catch up. So at least, compared to 8,900, we should end up somewhere around 10,000 crore at least by the end of the year. And this will also, even if we do a little better than what it is in the third and Q3 and Q4 compared to last year's, we should be able to easily reach 10,000 crores. That will be a 10% plus growth in terms of the disbursements. And that should also help us in the asset growth.
How much of your current loan growth is coming because of your channel or because of your association with Can Bank? I mean, how much is generated by Can Bank? How much is not generated from Can Bank?
No, we don't have that tie-up with Canara Bank where leads are forwarded and everything. We have our own internal sourcing. One is the DSA channel, which contributes to a very large component of the sourcing. And then a little bit of it comes from the direct sourcing and online. So mainly it is our own internal DSA sourcing, which brings the disbursement. We don't have any tie-up with Canara Bank.
Because of the issue in Ambala where you had to fix the problem, could there be a near-term uptick in NPAs? Because I was looking at the NPA trajectory, suddenly it's gone from 0.6 to 0.76.
Correct. No, it's not because of because that had nothing to do with the asset side of the book, the Ambala issue. So not because of that, but we had, if you recall in the last quarter also, or in the beginning of the year also, indicated that we have a almost 690 crore restructured book, which is going to come out of restructuring. And we had anticipated that, there will be some NPAs which will come out of that book as well. Because the customers who had opted for restructuring had taken it at the time when the rate of interest was the lowest, whereas today the rate of interest are at a peak. Plus, this 2 years of restructuring means the interest has been capitalized, and so therefore, when they have come out, the actual EMI is on the higher side. So because of that, there is a little bit of this. So we had anticipated, although it is I wouldn't say on the expected lines, but it is still there. And to cover up for that, we have anyway taken a management overlay. So in terms of the provisioning or anything, I don't think any further impact is expected because of this. And in terms of our non-restructured book, our NPA levels are very much in line with what it was in March. We had a 0.55% gross NPA in our non-restructured book, which continues on very similar lines.
On the positive side, though, Mr. Iyer, there's been a uptick that one has seen on your NIIs, almost about 26% driven by better yields. How is it that one should look at this? Is it on account of repricing of loans to reflect rate hikes, or is it on account of a change in portfolio mix?
No, there's no change in portfolio mix. It's mainly because of the rate hike which was yet to be passed on. we have an annual reset clause wherein the interest rates are reset once in a year, depending on the month in which the customer takes the disbursement. In these cases, we had at the beginning of the quarter around 12,500 crores, which was yet to experience one last rate hike of 35 bips. So out of that, around 6,000 crores have actually experienced that rate hike in the last quarter, that is Q2, and another 6,500, 6,800 crores is yet to be see that last round of rate hike. So there is a little bit of buffer we still have in terms of the pricing that we have to pass on to the customers.
SBI management last day said that this Dussehra you will expect a special scheme from us. Would you be also considering something like this, Diwali Dussehra? Maybe some schemes, maybe some discounted rates?
We actually have announced a slight, better rate for a segment which is having a higher, CIBIL score or a credit score, as well as customers who are in the slightly 35 lakh plus segment. So we have already offered that, and we will see how the market reacts. If required, we will also offer something, because now, as you have seen, we have a good, our spreads have slightly improved and gone back to the old levels. So we have a slight possibility that we can offer a little better rates for the rest of the segment also. So we have also done something similar, although may not be on the same to match SBI, but with a little bit of difference from SBI rates, we have offered something for our customers as well.
Sure. Okay, Suresh, great to have you on the show today and highlight how the quarter has been, what's the visibility looking like, and clearly, assuring us that Ambala was a one-off case and there shouldn't be any concerns emerging on the NPA book henceforth. And they're sticking by with the loan growth guidance, that of 18% for the full year. Let's now take stock of what is happening in the market. Nothing much. We are in quiet consolidation mode. So let's address chart busters. And Naresh, let me come to you first. What's the chart that you've identified?
So that's a chart for Kaveri Seeds Company, KSCL. Now, Kaveri Seeds has been sideways for the last 2 years. Multiple times it has made an attempt around that 620, 630 mark. That was the high in September of 2021, April of 2022, as well as very recently a few weeks back. Finally, the stock has broken out above the 620, 630 mark. 2 years of consolidation done, very strong volumes in this up move. Expecting this breakout to go to the highs of 2021 of around 800 odd levels. A buy at current levels as well as on dips, stop loss at 600.
Let's take it across to Kunal as well. And Kunal, what's the chart that you've identified?
Well, it's on the Nifty 50 and how the indices have been stuck into a tight range. So I just want to look at the charts for the indices and the two more important levels for the index traders. Now, this is the charts, very recent charts over the last one and a half odd month for the index. The two gaps which have been formed for the index, this was from the sell-off of September highs of 20,200 for the Nifty, and this was the first gap which was created for the index, and this was the second gap which is formed on the index. And if you look at the second gap, it's acting as a resistance band for the Nifty. Over the last few days, there have been multiple attempts for the index to try and at least claw back to this resistance zone, trying to fill the gap, but it's failing to cross over the gap as well as fill the gap entirely. And on the downside, you've seen that this has been major support for the index, which means we are stuck into this band of 300, 400 points broadly for the Nifty, 90,450, 500 as a support for the index, and closer to 90,820 as a resistance. Now, generally, when we see gaps getting filled as well as crossed over, we expect a start of a new trend, and hopefully we expect that this time around the Nifty will probably scale past above the upward gap and start off a very strong uptrend. So that was one of the major reasons why the index is stuck into a range and the action is being a bit more stock specific.
Okay, and let's talk stock specific then. Kunal, your list?
So two buy calls. City Union Bank is something which is popping up on the radar. The stock is trying to make a very strong comeback after being down at 52-week lows for the last many months. So would suggest a buy with a target of 155, stop loss 135. And Balrampur Chini is also heading towards a classical breakout on the short-term charts. Would suggest a buy with 455 as a target and stop loss at 420.
Okay, and Naresh, let's have your stock ideas as well.
So maintain a buy on Sun TV, stop loss at 630, target price of 700, a buy at current levels as well as on dips, a 2-year high breakout here. Second is a buy on Hero MotoCorp, showing relative strength and good momentum, stop loss at 3120, target price of 3400.
Let's take a very quick break. When we come back, more managements and more earnings calls.